Welcome to video lesson 3.2. Thank you for joining us. In this lesson, we will be talking about daily and weekly structure. So I know we've went over this a bit in previous lessons, but we're going to take a whole lesson to go over the structure of the week and the day and the different variations that each week will present to you. You know, a there's a pattern that will occur, but this pattern occurs in different variations, and the more variations that you get accustomed to, the better chance you have of predicting the next variation. So here is Euro odd, a 1 week structure, basically from Monday open right here to Friday close right here. So as we discussed, the daily structure looks similar to this. This is one of the variations of the daily structure, where we are presented with consolidation, a spike to the high, then a spike to the low, and then an end of the day in consolidation. This is our daily pattern. You'll see this occur almost every day, and the Asian session will be the consolidation period. New York session will be the breakout, or excuse me, London session is the breakout. You can see here, London session, they came up, the dealer came off of the high that was created here, spiked the high with the railroad tracks to activate any pending orders above the high, then came, shifted below the high with the railroad tracks. You could have entered here in a sell, and then you see that downward push. This happened London session, and then London session they dropped the price. A lot of the time you will have two opportunities to trade within one day on each pair. What I mean by that is there will be days where you are presented with something like this: a consolidation phase, a spike to the high, and then London session, they come, make the second leg of the M, then reverse, spike to the low, then come, make that first leg, spike to the low once more, off of that first leg, creating the second leg of the W, and then coming off of that W into consolidation for the day. There will be days where you are presented with this. You are actually presented with this here. You could have taken this as a W and bought it back up. Taking that as an M. That is a valid M. Sold. Taking it down. Your take profit is the second leg of the W, and you could have bought right there. But that is the daily structure. So there will be variations of the daily structure that happen that will form or help create what is the structure of the week. So let's discuss the structure of the week. We talked about in previous lessons that Monday and Friday are consolidation days or trap days, and that is to connect the week to the next week. You can see the consolidation connects each week. They connect the weeks together. This was last week. This is this week. And then here is the consolidation for the coming week. But let's focus on this week right here, because we can see it's an obvious trend, pretty obvious trend. And we can see a nice structure of, the pump and dump in here to create that trend, the downtrending environment. So what happened Monday, Tuesday, Wednesday, Thursday, and Friday? The dealer opened the market with a gap, came below the gap, induced the sell, came up once more, created that M formation here, did not break the high, and then dropped price. Created a low of the day on Monday, first leg of the W, second leg of the W. You could have taken that up. The dealer then spikes the low, inducing sellers, then slowly brings price back up, consolidates in this zone, then spikes up, one sharp candle, completely clearing out this zone, and comes up and creates a new high of the week. We are now on Tuesday. The high has been created. The dealer works off of that high for a bit and then comes down and consolidates into the next day. Wednesday, the dealer dumps price. We can see the M formation here. The dump of price. Price dumps. Remember what happens Wednesday. Wednesday is the middle of the week. Expect a reversal or a retrace. We can see price came down, created the low right here. That was the low, and then came created that first leg, then created the second leg. You can see the second leg of the W, very volatile, has the star below, or the star pattern closed above the low, the predetermined low right here. Then what happens? The dealer reverses. Remember, it's Wednesday. The reversal is imminent. Price reverses, retraces all the way back to this zone again. You can see what happens then. He creates that M formation once more, spikes to the high, creates a high of the day here, does not break the high, the higher high, or the high of the week. Then dumps price once more. What happens here? The dealer stop hunts to the low, opens up the spread a bit, grabs any pending orders or stop losses within this area at the low that was already created, and now this would be the new low. That second leg came down, created that new low, and now price comes up, works off of it, works off of the low here. Whoops, the low that was created here, the low of this day of Thursday, then Friday, the ending of Thursday and the beginning of Friday, the dealer consolidates, spikes to the low. What does that do? He created a spike, picking up any pending orders past the low of the week that we have and hitting any stop losses. Then what can we expect Friday? A trap or consolidation. Well, we have this big spike to the low. We can expect a reversal. We can see the W, and then price comes up. That big spike to the low right there. Then price retraced all the way back to consolidate back and end the week to start the next week in consolidation. So the dealer ended Thursday with a spike to the low, inducing short holders or inducing retail traders to go short, then spiked to the high and trapped all the retail traders over the weekend until the next week. And that all happened within this trend. And you would have no idea what's going on whatsoever if you're just plotting these lines like this. You have no idea what's behind the movement. You don't know why it's occurring. Now you know why it's occurring. Now you can see. Now you have the eyes to see what is in front of you without needing special indicators or scanners or anything like that. So let's move on to Euro USD. This is a great example of how the dealer works the highs and the lows of the week and the day and the month. So what can we see here? We see the dealer opened price with a gap. He dumped price in one candle, then came up, created that star formation, then dumped it again. Trapped retail traders long, then dumped price. This was a retail trader trap short. Pump price up, create that M formation, spike to the high, and I want you to notice one thing here. The dealer works the highs and the lows because that's where the money is made. He makes money off of the spread. When he opens the spread, he can grab orders above the highs and the lows of the day, and that's where many retail traders like to trade off of. And if we see, here is Monday, Tuesday, Wednesday, Thursday, and Friday. What do you notice here? We notice each day the market is ranging and getting larger, or ranging farther apart, creating higher highs and lower lows. Creating that wedge you can see right here. The dealer works the highs and the lows of the week, then reverses. You can see the dealer created that low of the week here, then created a new high, worked the high for a bit, broke the high, created the new high here, worked that high for a bit, consolidated there, shifted the zone, came down, consolidated here, worked the low, remember this was the low, then spiked, created that new low, spiked completely past the previous low, then shot up, $110 pips. You can see the consolidation right here, all of this consolidation here, and then that one massive spike to the low. That's your key. That's the dealer showing you his hand. He spiked past the low, hitting any stop losses of any buyers that were in this consolidation period. Also, hitting any stop losses of any buyers. Oh, I'm sorry, I'm losing my voice. Of any buyers that are having their stop loss below the low of this, the low of the week here, the previous low. So, the dealer spikes to the low, hits your stop loss if you were selling, or excuse me, if you were buying and you had your stop loss at the previous low, and then creates that new low. At the same time, he also induces retail traders that trade breakouts to sell because they saw the breakout of this consolidation range. They saw that big red candle. They sold there, and then they were punished. So that's basically what happens week by week by week. And we can see here price came up, created a new high, blew out this high, blew past that previous high. You can see it stuttered. Price stuttered at that high as if it was going to fall again, and then the dealer pushed right past it. The new high is now here. We are at Thursday. Friday, we could have taken the spike to the previous day's high. So we see the second leg of the M was at the previous day's high. That was also a railroad track confirmation. You could have taken that short. We have that spike to the low. Then the move up to end the week. They hit any stops above the M right here or that previous high. If you were holding your trade, you were holding your sell, they hit your stop loss, then that new high was created here, and then the week ended with a close and a small gap to the upside and a complete reversal of about 200 pips back down to the low of the month here. So you can see how this widening of the highs and the lows is what the dealers do. The dealers work the highs and the lows of the day and the week and the previous day to trap volume at the highs and the lows. So, thank you guys for watching. This was video lesson 3.2 on weekly structure and daily structure. Hope you enjoyed. Peace out.